Welcome to another episode of the Hube Knows Best pod, where I'm going to give you the truth, nothing but the truth, well, as best as I can, so help me God. Today we have a special guest, Miss Johnita Herndon from Associated Bank. She is an expert on lending, and so we brought her in today to kind of give us some game on best practices when approaching anyone when you're looking for financing for your residential property, whether it be a single-family home or multifamily. So, Johnita, thank you for coming.
Thank you for having me. I think this is to be very helpful. I have some good tips and tricks to kind of help navigate through that process. So,
perfect. So, a lot of my friends are buying homes. Mortgage rates are crazy right now, and everybody is kind of like wondering, like, when is everything going to go back to normal?
Yeah.
And we know that's not going to happen anytime soon.
I know. And it's hard for us to, as mortgage professionals to kind of predict that, it's so many things that kind of go into play with the Fed and inflation and the bond rates. So, and no one can really know that unless you have psychic powers. But from what everyone is kind of saying, we're hoping to have an ease in rates over the next 1 or 2 years. And that's probably what I'm thinking. Unless something drastic happens, and I really see the rates coming down in about 1 or 2 years.
Okay. So with that in mind, like, before somebody reaches out to you guys, like whether you work for a bank, right? And so what should they be doing? What steps should they be taking?
I mean, one, you want to be mindful of credit. Credit is the biggest thing and driving factor in that process. If you are trying to get a loan from any institution, a bank, a broker, credit is going to be the main piece. So checking your credit, getting a free credit report. You can get an annual credit report, freecreditreport.com, seeing where you are, just knowing what's on your credit. I get so many people working with a lot of first-time home buyers that just don't know what their credit score is. So, using those resources, there's always Credit Karma, there's Experian, there's free resources that you can get to at least just monitor your credit. Right. And then at least so going into a conversation with a professional like myself, you can have a ballpark figure like, okay, my credit score is around this number. Okay.
Yeah, I know you spoke about those free websites. I also heard about MyFICO, which will give you like your exact FICO score for like what you guys are looking for.
Yeah. I always kind of recommend Credit Check Total as well. Okay. And that's another one. I think you pay $1 and they give you your scores, and they're pretty accurate to what we look, because we look at the FICO score. So, and each credit score has a different rating. So like a mortgage score would be different than like a car, like if you were buying a car. Right. So the credit score is going to be different when you pull for different things too. So, but we do look at all three scores. We use the middle of the three scores to qualify you. And, like I know sometimes when you buy a car or getting a credit card, it's only one bureau that we're looking at. But for a mortgage, you want to be mindful and know all three scores.
Okay. Yeah. Cool. So, we talked about the credit score, but what are like 5 things that you guys are looking at?
Yeah. So I kind of go through and have this conversation with anyone that's doing a pre-approval. So it's going to be credit. We're going to be looking at payments. Mm-hmm. So what you're making monthly. So car payments, student loans, credit card minimum balances payments. Anything that you're making monthly, we will be looking at, because that's how we determine your debt to income. Okay. Then income. What you're doing for work. Are you self-employed? Are you working a job? What's your history? Are you just getting out of school? That's a big part of qualifying for the loan as well. Savings. Do you have any money saved for a home? Because, most programs require at least a 3 to 5% down payment. Right. So we're going to be looking at that. Bank statements, checking accounts, savings, retirement, anything that you might have. Where we at? That's 4.
So you said
I said credit, payments, monthly payments, savings. 5, let's see, 2 other things that you want to do before kind of coming to us. I would say taking a home buyer workshop. Okay. I highly recommend that, because if you are brand new to the process, taking one of those workshops, and there are a lot of free workshops with housing agencies, HUD approved agencies, that will give you like a 3 or 4 hour workshop and kind of just go through the basics with you. Mm-hmm. And, you get to work with a housing counselor. If you're nervous about, starting the process, that's a great way to kind of jump in. So I would say definitely taking a HUD approved homebuyer education course, and then just talking to friends and family. Okay. Just that people that might have just, purchased a home recently, what were their experiences? What would they kind of suggest to you? Kind of going through all of those things, getting all those things kind of in a row. And then I feel like that would put you in a good position to be ready to get a pre-approval and to start shopping for a house.
For sure. I know, like, I just bought a house, or bought my condo here in Chicago. And because I'm in sales, they were like, okay, what do you make? I'm like, well, I make this. But they pre-approved me based off of what I had made in the prior year. And then we got into the process because we're in sales. It's a recession. There's different things going on. So the beginning of the year, my numbers weren't tracking for what they were pre-approved for. And so they're like, well, we can't approve you for that. Right. So I think it's very important to understand, like, know what your ducks are in a row, like, know what your money's going to be. Make sure that if you say you're going to make this, that it lines up at the end. Definitely, for sure.
Yeah. And I think that, working with a good mortgage professional as well, because there's a lot of things that we can do up front. Like, especially if, in your situation where if you were in sales and you were receiving commission, that's something that we could look at up front and kind of have a good ballpark, or we can do a full pre-approval for you. And with that, it actually goes in front of an underwriter and exactly what you're going to be approved for. So there's no hiccups down the line. And I highly recommend that for a lot of my clients too. Let's go ahead. Let's do the pre-approval. Let's take a week, go through the process. And it'll just make your life so much easier on the back end when you're actually trying to close an under contract. Yeah.
Pro tip, don't try to buy a house in 30 days, less than 30 days before you go out the country.
Yeah.
Because, bro, it was so crazy. Like, who I got approved with was like, nah. Then I had to go get approval and get everything.
Yeah.
And, the money's there, clearly, but they were like, nah. And so to that point, like, segueing into that, like, I think, and you can tell me if I'm wrong here, but banks are they're going to scrutinize your numbers a lot tighter than, like, maybe non-banks that are, providing these loans. So,
it all kind of depends on your situation. So I won't say that a bank is better than a broker or a broker is better than a bank. It depends on your specific financial situation and what type of loan that you qualify for. And that kind of goes back into your credit score and everything, like your past credit histories. You have bankruptcies and everything like that, because a conventional loan might be a lot easier to qualify for versus a bank's FHA loan.
Yeah.
So the FHA loan is going to be a government-backed loan. And a lot of times you're going to have to pay an upfront monthly premium and a monthly private mortgage insurance, where it's going to be more costly to get the FHA loan than it is a conventional loan. But depending on your financial background, say that you might have had a bankruptcy and you can only do an FHA loan, you might have to go that route. So each person is going to be different. And I get that a lot of times, well, somebody told me to do this type of loan, but your financial situation is not going to be the same as that person. So that's why it's good to do that pre-approval, so what is going to be best for you, and it's going to get you to that closing table into your new house.
Okay. All right. But I think you just kind of like perfectly segued into like the next thing was like FHA versus conventional.
Yep.
Like, could you kind of give the audience a little bit more like what's the difference? What do people prefer? What would you do based off this scenario?
Yeah, it really kind of depends. One, like I said, biggest thing is your credit profile. What's your credit score? Do you have any collections, judgments, bankruptcies, anything like that? Because that's going to determine whether you're going to be able to get a conventional versus a FHA loan. So say that you got, in the perfect world, 750 credit score, you got your down payment, never been late, never did, anything like that. Most likely you're going to go with a conventional loan. Say that credit's a little bit lower, 600s, maybe, had a bankruptcy, got some collections or something, we might have to just go FHA. Now, it can also depend on the type of property that you're purchasing. So say that you want a condo multi-unit. A lot of times, let's start with the multi-unit. If you want FHA loan is going to be a great way for you to buy a multi-unit with a low down payment. Okay. So it's going to be 3.5% versus if you went conventional, you will need at least 20% down. So in that situation, even if credit score and everything is good, it might be better for you to go FHA because you can get that multi-unit that you want with a low down payment.
Okay.
Now, say that, let's go with condos. I will say a lot of condos are not FHA approved. So condos have to be specifically FHA, have to go through a process that normally takes 90 days to get approved. So if going into this, they're not FHA approved, you might have to go conventional. Or if you can't go conventional, maybe the condo's not going to be the best type of property that you buy right now. So all of those things can kind of go into play as to, where you're purchasing, what type of property, if you're going to go FHA versus conventional. I won't say one is better than the other because it just depends on your financial situation.
Yeah, for sure.
Yeah. So we really have to, a lot of the times I kind of weigh both options, especially if a customer qualifies for both. I show them the difference in payments because your FHA loan payment might be $100 or $200 more than conventional on the same property.
Right.
So do you want to go that route? Maybe it's if you put 5% conventional, down payment on that, but versus 3.5% FHA, your payment's way different. It might be better to put that extra down payment to go conventional.
Yeah, for sure. I think I was going through that process, especially when I had to switch lenders, and they were like, do an FHA. I was like, bro, my broker is telling me that's going to take way longer than I have time for.
Yeah.
I was staying at my friend's house in Bronzeville, and she was coming back into the state from, travel nursing. And I was like, bro, I got to be out of her house. And I'm about to go out of the country for like 2 weeks.
Yeah.
I don't really have time to go through this process. I need this house.
Yeah.
And I was like, I got the money. Like, I'm looking at my commission check for the end of the month. Like, we're going to be okay.
Yeah.
But yeah, no, I definitely understand that. Now, and, maybe I'm telling the wrong person this, but like I think part of the process of what took me so long was I was shopping for rates, right? So I had both of my banks competing with each other, and then I had a mortgage broker giving me rates. So like, tell me about that. Like, I know that's like,
yeah.
I get tired of people doing stuff like that.
I mean, but you as a consumer have a right to shop around for rates. I mean, even me being in the industry, I would do the same thing. Why not? Because if you don't shop around with rates and if you just take whatever rate somebody gives you, then you just didn't do your due diligence as a consumer. No. So I do suggest it, shop around for not just rates, shop around for programs. Because a program that I might have, somebody else might not have. Maybe you just got approved, you went to one lender or broker and they said, only loan I can give you is FHA with this rate, and this is what your payment's going to be. But you didn't come and talk to me. Maybe I have a specific program that I can get you approved for portfolio loans. Banks offer portfolio loans. And if you don't do your due diligence and shop around for those, it's no way that you would ever know about that. So I always highly suggest and say, I always, we're working with people, my whole goal is to set you up for success. Right. So if I know of a program that might benefit you more, I might refer you to one of my colleagues, because if I look at your profile and say, yeah, maybe I can only get you FHA, but they got a great program for you, I would go ahead and suggest that over to you. Yeah. Because if you don't know about it, if you're a first time home buyer, maybe you just don't know how to ask those questions and kind of go to different lenders and just know how to ask the right questions. So definitely you want to just shop around and, just do an initial call with the lender and say, what programs do you offer for a first time home buyer? What are the normal, what are the average rates? Of course, we're going to want to do a full application to be able to give you a firm rate, but it's good to just kind of get a ball. I suggest to call maybe 3 to 5. Just so you know what's out there, because in your community, because there's different programs maybe in that area that you're purchasing in. Yeah,
because when I was shopping, they were like, "Oh, you're in Chicago. There's like this program that's for like certain income."
Yep.
Of course, I didn't qualify. That's not even home practice. I get tired of not qualifying for things, whether it be student loan debt, whatever. Like, but I'm blessed in that I don't qualify for some of those things, and people that actually need that help and assistance. I think that's very important, though, especially with stuff like NACA.
Yeah.
Where you don't have to really do much other than give them a down payment.
Exactly.
And then, different banks, like you said, different banks, different mortgage lenders have different programs.
Yeah. And different loans. And like one thing because with working at Associated Bank, I do a lot of, it's called our CARE loan. Okay. So our CARE loan is a portfolio loan for first-time home buyers.
Okay.
And it's 3% down with no PMI. That alone, getting rid of the PMI, saves you.
I'm tired of paying PMI.
Yeah. So, if you could get into a program like that with no PMI, but if you don't know, if you don't shop around, how would you know about that program? Because you might have just went to someone else and they said, oh, with your credit score, I can only give you an FHA. But with our program, can get you into that at 640 credit score. That's, basically that's what you need. So I get a lot of people that, I only got an FHA pre-approval.
Right.
And then I can get them into a conventional 3% down, no PMI. All because they maybe got referred to me or they shopped around. So.
And can you, for those people that haven't bought a home yet, explain what PMI is?
Sure. So it's private mortgage insurance that is required. If you don't put 20% down, it's like an insurance for the bank. If you ever defaulted on your loan, the bank would have security and be able to, recover your loan. So it's required on basically all loans if you don't put 20% down. And it's basically calculated on your income, how much you put for your down payment, how much monthly that's going to be. So being able to not have that cost, like I said, I kind of give it, on average, it can be anywhere from $50 to $200 extra a month in your payment, or even more than that, depending on how much your loan is and what your credit score is. So
yeah, and this is kind of tangential, but what's the difference between to a bank, between me having a 650, a 700, and 750? Why does that really matter if I got the money?
Because it's more risk for the bank. So with the lower credit score, it's more risk because, maybe at the lower credit score, one, you have an established credit. So we don't have a history to show that you've been making payments on time. Or if your credit score is lower, maybe you missed some payments and the bank's seeing that. So that's why you might have a higher interest rate at a lower credit score, where if you're at a 750, you're going to get the best interest rates. So, it's tiered for most programs. It is tiered where, your 750 score is going to get you a better interest rate than you were if you were at 650 or even 700.
Yeah. And I've heard people say because I bought 2 properties and they're like, well, this is the best rate I can get you at that credit score.
Yeah.
And you're like, okay. Yeah. So that's very important to know. Now, I think we touched on this a little bit earlier, but when you're buying a single family residence versus a duplex, triplex, fourplex, what have you, what is the difference in approaching that? I think you said you gotta have 20% down, or you're going to be on. Yeah.
So it depends because, and if it's is it a primary residence? Are you going to be living in there, or is it an investment property? So that's going to be a deciding factor of how much down payment that you're going to that you would need. So. And the reason that it's a higher down payment going to 2, 3, 4 units is because it's one more risk. That's how the bank assesses risk. So with us giving you a loan at hundreds of thousands of dollars, we have to assess the risk to make sure that you can pay us back.
Right.
And if, that you can also say that you go and buy a 4 unit. Can you, if you lost your job, are you able to maintain those payments? Sometimes you'll even need reserves. So in opposed to just a down payment, anywhere from 3.5% to up to 20%. So you also may need to have reserves. So sometimes it can be 3 to 6 months reserves, and reserves are just going to be the monthly payment times 3 or times 6. But then that would be your mortgage, taxes, insurance, everything times that amount that you have to have addition into your down payment. So you might need to have reserves as well. Even on a single unit, sometimes you might even need to show reserves on buying a single family home or a condo. So it's always just good to kind of, especially you want to show the bank any assets or anything you have when buying those properties. But just kind of pivot back to just the difference between, buying a single unit versus multi-unit. When you are purchasing and we do a qualification for a 2 to 4 unit, we can use that rental income that you're going to make off of that property to qualify you for. So your approval amount on a single unit versus a 4 unit, your 4 unit is going to be way higher because you're going to be getting 3 rents coming in off that property if you're living in one. So your approval amount can be way higher on those too. So it just kind of goes back and, into the qualification of what you kind of qualify for. Do you have the reserves? Maybe, you don't need reserves on a 2 unit. Maybe you just want to do a 2 unit then. Maybe you don't have additional 6 months, but you can still get a building. You can still have a tenant in there and you live in another unit. So we kind of go through and we kind of assess all of those things, as what's going to be the best situation for you. And then if it's, say we want an investment property route. Now I get this question all the time. How can I get a lower down payment on an investment property? The investment properties they are the most riskiest. You're going to get the highest interest rates and the highest down payment on investment properties because if this is not your primary residence, if you have to be a landlord and you have to be a tenant, that's going to be the most risky loan that a bank is going to take because one, if you're living in there, I kind of feel like more people like, okay, this is my home. Like, I'm going to make sure that things are up, up to par.
Make sure we paying rent.
Yeah.
Yeah.
You're going to make sure. And then, like, if it's an investment property, it's like, okay, well, I got my place to stay. Maybe you're going to let this go to the, if something falls through, you want to get your tenants in there.
LLC in my trust.
Exactly.
I file bankruptcy on it.
Exactly. So that's where it's more riskier. And that's why the banks want 25% down. They want to see 6 months reserve, to give this investment property and give you a higher interest rate.
Yeah. I think something that I saw, like, because I spent a lot of time on Instagram scrolling, finding different things. And I think I heard like of a DCR or DSRR loan, where basically, like, based on the rents, like you were saying,
okay,
you can get like a no down payment, whatever type of loan.
Yeah. Well, that's the first time I've heard of that.
I'll share with you.
Yeah, share that with me because, and I know that you can use the rent. I mean, that's kind of standard for any lender or anything, but that might be like a special program.
I think it is a special program, for sure. All right, so, you've given us a lot of information here, but, like, tell us a little bit about you. Like, what got you into this line of work? Like,
yeah. So I've actually been in the mortgage industry it's going on 11 years. It'll be 11 years this year. I started out of college. I am a finance and econ major. But
where'd you go to school?
I went to school, actually, Olivet Nazarene, so it's an hour south. Oh. And it's in Bourbonnais, Kankakee area. Okay. So I went there, and actually, when I got out of college, I was working at Victoria's Secret. I was a manager.
A job's a job. I worked for a CPA out of college.
So right out, I have worked there during college. They offered me a manager position. I went into that. I got a call one day from Chase, and they're like, "Hey, we're hiring for mortgage processors," and I'm like, I work at Victoria's Secret. Like, I don't know the first thing. I hadn't bought a property. I didn't know anything about a mortgage at that time. But I took the position, and it kind of just went from there. So I was a mortgage processor. I did operations for about like 3 years. From there, I went to be a mortgage assistant to a loan officer. And that's when it just opened my mind. Like, I didn't even know this existed. I didn't even know that this is something that I could do. And I was very good at it, being an assistant for many years. And then I saw also, like, man, I'm making this guy all this money.
I could be making money myself.
I can, so I was an assistant for a couple years as well for top producing loan officers. And in the Chicago area. And from there, I'm like, this is what I want to do. I want to have my own clientele. I want to work with people that look like me. I want to help them achieve their goal and get into a house. So that's why I specify in community lending, because that's what I've been doing for the last 4 years, helping to find programs. What can little knacks and everything? What can you do to get into your house? Helping people that just think that they never could have bought a home actually buy their first home. So that kind of like is my whole driving factor of like why I really do this, because at the end of the day, just helping that client or helping that family that thought that they could never buy a house, really getting them into a house and helping them achieve their goal is like all in be all for me. Like that just is like makes my day.
Anything special going on at your bank that people should know about right now?
So we do have a lot of programs. I know I kind of touched on our CARE program. That's the product that I use a lot. 3% down, no PMI. The way that you can qualify for that is one, where you're purchasing at. If the property is in a low or moderate income area and you don't own any other properties, you can buy that. You can use that program no matter what your income is. You can make $1 million a year and you can still go and use that CARE program and buy a property 3% down, no PMI. You can also do a 2-unit on that program, 5% down, no PMI. So that's our niche, that CARE program. We also have grants. We partner with a lot of different organizations with grants. So directly from us, we give $7,500 to first-time or repeat buyers. It's basically in Cook County, if your income is under $90,000, we give it to you, and it's 100% forgiven at closing. You don't have to stay in the property a certain amount of time or anything like that. It's just basically a lender credit, and you can use that for your down payment and your closing costs. So that's our big thing. But we also we partner with the Federal Home Loan Bank of Chicago with grants. So you could layer, if you qualify for multiple grants, you can layer it. I had multiple people this year that got $15,000 plus in grants for purchasing with our PATH grant with the Federal Home Loan Bank. And then we also are a preferred lender with South Suburban Housing. They have a grant. So anything in the South suburbs, Calumet, Dalton, Madison, all those areas, you could potentially get a grant up to $15,000 for purchasing in those areas right now, and combine it with our $7,500. So I know that rolled out end of March, and they do still have funds available. From what I heard, they still had about 15 grants left, and I've had 4 or 5 people that have gotten the 15,000, like 10 or 15,000. So that's a really good grant that I've been kind of like promoting and everything too, because especially if you're buying in the south suburbs, you should definitely try to take advantage of you getting that, because when you get that grant money, you can use that to buy down your interest rates. So you have money for a down payment. There's extra money left. Let's lower your loan amount. Let's buy down your interest rate. If interest rate is like what's stopping you, that's a good way to use grants as a hack to kind of buy down the interest rate.
Yeah, both of my properties I bought down already.
Yeah,
it's I'm definitely gonna refinance the last one I bought and get it down even lower. But like at the time when I bought my first house, I think this was before like interest rates went way down in 2020. In like 2021, when it was like people was getting like 3s. I think mine was like 4, and I bought it down to like 3.5 or something.
And that's a great rate. People would die to get a 3.5% rate right now. Yeah. We're closer to at least 7%.
Yeah,
as of today.
I looked over the weekend. It was like 6, 7.
Yeah,
so like it jumped back up.
Yeah, so it's been teetering around that. It went down a little bit for, I want to say like March, April, it was down about 6%, but it's back up at least 6.8 to some even 7.5, depending on what your credit score is.
Yeah, my friend was telling me like that's like big boom time, especially up here, because it started getting warmer and people start closing. Like I was like following so many properties on like Zillow. Yeah. And I kept getting notifications. This house sold, this sold, this sold, this sold, this sold. I was like, oh, she wasn't lying. I'm glad I got my house before the market went up and went crazy, because the prices was going back up on those properties. Yeah. Too.
And I'm still seeing a lot of bidding wars on properties. I mean, it kind of just goes back to lack of inventory. It's just people need some, people need to move. People need housing. So, and if it's a good property that comes on the market, people have been waiting for, properties are still getting 10, 12 offers right now, even with interest rates over 7%. So,
yeah. Well, I definitely thank you for coming in today. I know you're a busy lady. Got to let you get back to work. Hey, guys, I know the process can be scary. It can definitely be tough for y'all. But, just stay the course. Take your journey, get your research in, do what you need to do to make sure that you're educated and you're prepared as you go into the process. Tune in next week. We have the VP of Lending from Molitor Financial Group, Terrence Terrell. So, he'll be able to, piggyback and probably give some more insight about this particular topic. So, with that, I encourage you to be your best self, because everybody's already taken. I wish you peace, patience, understanding, knowledge, wisdom, discernment, and health, strength, resolve. Till we meet again, be easy or not, but every choice has a consequence, and every action has a reaction. Peace.